What's up, everybody, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. As always, I'm your host, Cody Laughlin, and joining me this morning is my buddy, Mr. Brian Alfaro. Brian, good morning. How are we doing?
Good morning, Cody. Good morning, Nick. Excited to be on the show today. Looking forward to this one.
Yeah, man, we have a very, very special guest today. I'm really excited about our conversation this morning. So tell us who we're talking to today, Brian.
Yeah, this morning we were talking to Mr. Nick Moore, and Mr. Nick Moore is a commercial real estate and corporate attorney who's located in Atlanta, Georgia. Since 2012, Nick has been involved in real estate law in various forms, including acquisitions and refinancing with retail, fast food restaurants, multifamily real estate, and self-storage real estate, all great spaces. Having assisted clients with multi-millions in real estate deals, Nick guides his clients from the inception of the deal to post-close business matters and everything in between. Nick is also a general partner in commercial real estate and has assisted in the formation of private equity funds, limited partnerships, syndications, debt securities, and corporate structure revisions to accomplish his clients' complex objectives. In 2020, so this year, Nick was selected by Super Lawyers as a Georgia Rising Star for the areas of corporate and business, which is reserved for the top 2.5% of attorneys in the practice area. Nick lives in North Metro Atlanta with his wife and son and is expecting his second son in February in 2021. Congrats. When he's not taking down deals with his clients, he enjoys hiking, golfing, and spending time in his church. Mr. Nick, welcome to the show.
Thanks, gentlemen. Appreciate the introduction. Happy to be here.
Yeah, Nick, we're excited to have you, man. Again, really, really excited to have you on. And I think it's a relevant timing as well to have somebody with your specialty come on to the show. And I got to tell you, man, I'm always excited to talk to professionals like yourself who not only have a specialty as a quote unquote commercial real estate professional in a way, but also being an investor yourself. That's always exciting to me when you kind of live, both worlds and such. And, it kind of gives you a 360 view of every aspect of the business, but I love it. But man, tell us a little bit more about yourself, how you found yourself in to become an attorney and how you found yourself in the commercial real estate space.
Yeah, I mean, we started back in 2012, just doing general commercial real estate stuff and just kind of, picked it up and worked with it and just really enjoyed it. From there, just, it's kind of funny to try to articulate the journey because it just takes you in so many different directions. But the clients are number one. The work has been exciting, fulfilling. I've got a beautiful office space, that's really just, sorry, I've got my connections a little bit. Can you guys hear me okay? Good. So I got started in 2012 with a commercial real estate attorney and just picked up the material and loved it. Started my own practice in about 2017. In 2016, I worked at a telecommunications company and realized that the corporate deal just kind of wasn't for me. And I was doing some stuff in the background and just loved it. And then just kind of got moving forward from there. And, really just kind of settled in, started picking up clients here and there and, kind of the rest is history.
Well, I mean, obviously it's definitely paid off for you. You've had a lot of success throughout this, past almost 10 years and, recently being recognized, as Brian alluded to, by the Super Lawyers as a rising star, man. That's really cool. That's awesome.
So that was a unique surprise. It's funny. I was actually here in the office one day and the email came through and it said Super Lawyers, and you'll get some of these advertising things and just marketing blasts here and there. And I had just happened to click on it and it started with a congratulations. And I thought, no way. Opened it up and yeah, sure enough, the recognition was there. Being I probably gave a pretty lukewarm introduction there. I mean, it's just your brain, it It's difficult to articulate exactly the journey that I'm taking because it's meant a lot. It's been a special time, and I've really enjoyed it. And to kind of culminate in a recognition like that when you're a smaller firm is a pretty big deal. Kind of to speak a little bit more particularly about the background, when I left the corporate job and got into more of a general counsel external capacity, I linked up with a colleague of mine, and he had sent over some work and said, "Hey, I've got some overflow work here in the commercial real estate space. Why don't you check it out?" So at that point, was kind of working with some operating agreements and things, and kind of, from there, he started providing some transactional stuff and was like, "Hey, well, why don't you work on this for a little bit?" As kind of side work and overflow, if you will. And I just picked it up and loved it, and then started interfacing with the clients. And everybody was just so excited about the assets. They were so excited about, just the prospect of taking down the deal and syndicating their capital. And I think maybe most importantly, leaving whatever job behind it was that they were leaving, and putting this together. And I think it's so unique to what we do, because this is a sophistication where it can be a hobby and it can be a full-time job, right? Be a full-time hobby. It just depends on the passion that you bring to it, and how successful you are in building relationships, whether it's with brokers, attorneys, of course, and access to capital, and that may lead us to a point that we wanted to talk about today, Cody, and the private equity fund. So, all that to say, it's just been a fantastic space. The passion that I bring to it, and the happiness, honestly, that it brings me to work on it I think is why I was able to get recognized by super lawyers. And then the other things that I do, the general counsel. So I work with these business owners once they get the acquisition from a business perspective. A lot of these guys have other businesses that they own, or in a capacity where they can reach out to me for, for other legal services and things. And that's been a blessing. And then lastly has been litigation. I don't even know what to say there. I got into litigation because some matters came to me, and I needed money. I'll be honest with you. I was just a couple years out of school, and I'm really trying to grind, and building corporate clients can take some time, but there's always litigation stuff. People are always trying to fight it out in court. And so I said yes to a few matters, and then really got the hang of it. And now, between having commercial real estate experience, having litigation experience, and then having that external general counsel, you do have that 360 comprehensive view of these transactions. And frankly, I don't know how you can be that good at drafting if you don't know how to litigate it. And if you're not giving ongoing advice, then how are you having the experience to know what to put in these agreements, or provisioning the business on behalf of your clients? So I'm a man of faith. So I just believe God's always just put me right there in the moment, and given me all the experience and wisdom to be able to guide my clients. And it's been a fun journey in doing so. And I intend to do it for the next 20 years or less.
well, that's awesome, man. I love to hear your passion and your excitement when it comes to, doing what you're doing and representing the commercial real estate space. And, that's always exciting to have that passion. And I got to tell you, as kind of, I've gone through my journey in this space, and as we continue to build our business, it sounds kind of funny, but I love attorneys. Like, I love them when they're on my side anyway, because in these deals, as you mentioned, you're dealing with multiple partners, multiple $1 million transactions. A lot of different things that can legally affect you in a way. So having somebody like yourself on your team is absolutely critical. And, so really grown very, very fond of the relationships we have with our legal counsel, and always appreciate what you guys do for us as investors. But having said that, you've been working on your practice now for several years. You've been in the commercial real estate space as a focus, but you're also a commercial real estate investor yourself. How'd you find yourself investing in real estate in addition to your law practice?
It's a good question. So I was really had deep interest in the financial markets when I had my corporate job, because it was easy. You have your W-2 income. and you get it and you just kind of put it in the markets. And I was like, yeah, I'm not going to just give it to a money manager. I want to figure this thing out myself. And, um, and so, that's kind of really how I got into the investment mindset initially. Then once I started getting my hands on these deals that would come across, I'm looking at these numbers and I'm like, what? you know, we're talking about, significant returns that, that you can make in the financial markets, but not with any sort of consistency, right? You can't say, hey, if you put your money in this, equity right here, that you'll get, X percentage in X amount of time. Whereas in commercial real estate, not only can you do that, but you also have that tangible asset. It's not some intangible, volatile, equity that's at the mercy of the market, or the mercy of the performance of the business itself. We have a fixed asset, piece of property, and you've got a finite number of doors with contemplated rents. Hopefully, when you acquire, the occupancy is at a certain percentage, and then you've got a good handle on what your revenues are, and then from there you optimize those expenses, and there's your investment. If I put in X and I own X percentage of the company, what's my return? So seeing that really piqued my interest. So moved some money into a couple deals, and then thought, I'm making some money, obviously, preparing the purchase and sale agreements and the private placement memorandums and the other documents. And also, about small caveat, I think a lot of your viewers and maybe even you, Cody and Brian, have used counsel who one counsel does the real estate part and the other counsel does the security part. Well, I do both. And it's nice to have that consolidated into one space, because there's a lot of overlap between the two. And if you got to go over here to talk about an issue and then go over there, I mean, you could very well be getting double billed depending on what your payment rate is. So just some food for thought. But anyway, kind of lost my train of thought. Help me out, Cody.
No, you're good, man. You were just telling us about your kind of evolution as an investor as well.
Yeah, sorry. So as I prepare these cost packages, sorry about that. These cost packages, I realized, hey, there is an upfront fee, but what if I discounted the upfront fee and maybe took a GP percentage? What if I just did a small engagement fee and took a GP percentage? And then what if I just took a GP percentage only and didn't take a fee at all for the deal? And had enough volume coming through that I could kind of, see what my appetite was for any of these, which one felt like a better deal to me, what was a better value. And I realized that it's really a case by case thing. Sometimes I deal with the operators where it's like, look, let me just get the 7,500 to 10, 12,000, depending on the size of the deal. And then others, it's like, man, I really like what we're doing here. We seem to be building something. You can tell when you communicate with your clients whether they're looking for something more transactional or something more partnership based. If it seems like something they could really benefit from, my perspective, particularly with newer operators, it's a better idea to kind of get in there and get a little bit of percentage. That way, I'm accountable to the participation in the deal as a partner, and they're more inclined to reach out to me and talk about things because they know that they're not necessarily on the clock. So to the extent they have that equity to carve out on the GP side, I like to do that, and I've been able to do that on a few deals, and haven't led my own deal to the extent that I was principal or anything like that just yet, but there might be something in the works in 2021 in the form of a property group where I would be one of the principals, and then begin to build our own portfolio, which I think in the near term is going to be a little bit more focused in the self-storage. A little bit lower barrier to entry, smaller purchase prices, expenses are different, the lien laws are different as opposed to tenant laws. All in all, just a really attractive asset class as well. So that's kind of how I got into the investment space.
Well, man, that's exciting to hear. I'm excited to watch you continue down that path and grow your own portfolio, man. That's exciting. But I also appreciate the fact, and I'm really glad you mentioned this, because this is something I'm a very big advocate for, is partnering with your advisory team, right? If you've had that relationship, right? It's always great when you can partner with your legal counsel, your property management, sometimes even in some cases brokers, but it all, of course, like you said, it all comes down to relationships, obviously. But if you have those type of relationships and you can leverage the power of your counsel to also be involved in your deals, I mean, it just makes you a stronger team as well. So I really, I like that. And I hope the listeners kind of consider that as they're building out their team and whatnot. I know that's one thing that we're focused on, not just from a transactional side, but also, hey, how do we continue to build these relationships and see where it goes. So
That's exactly right. And that's the wise thing. And, some lenders like Freddie Mac often require the partnership with a property manager. So they'll have to be local to the asset. Typically, you've got to give them a couple of points, somewhere between 3 to 5% of gross, just so they know they have skin in the game. And then they'll dictate some of the termination clauses. But all the property managers are interested in that arrangement as well. So it really, it's kind of just a mutually beneficial arrangement there. But you're exactly right. To the extent you can build a core team, there are a lot of attorneys out here that are just purely transactional, or they're part of a firm to the extent that they can't do a partnership, and it's not, look, they may be giving great advice. Just know that partnership opportunity is not there, and you can, for the most part, and I don't want to overgeneralize, but for the most part, can pretty much anticipate, an invoice if you ring them. You call them up and want some advice. Of course, they may charge you for that. Whereas some smaller firms and more boutique practices like mine, have the ability to be a little bit more personal, talk things through, and then have the ability to stay, nimble in the partnership space.
yeah, yeah. And that's always something that, again, is very, very much appreciated when you can have that open line of communication like that. I think a lot of people may sometimes find themselves, especially newer investors in the space, they may kind of veer away from trying to reach out to their counsel just because of the fear of, oh, well, am I going to get billed for that time? Or, oh, that's another conversation or whatnot. And ultimately you end up kind of cutting a few corners and getting yourself into a pickle, and could be costly. So, but it's always good to have an open line of communication and have that good relationship. But anyway, man, I appreciate you sharing that. I want to kind of pivot and kind of get into more conversation about your legal practice, and in particular, this specialty that you have in equity funds. Yeah. And I'm really interested in that topic. I know that that's kind of the way that you and I and John had initially met many, many months ago, but
yeah,
has it been since May? Wow. Yeah.
No, John Beatty we're talking, right?
Excuse me. Yeah. Yep.
But it might have been May. I think we were pretty deep in pandemic when we had that conversation, but I enjoyed it.
Yeah. This whole year, man, it's all like everything's kind of blending together. Right? Time frames are out the window. But anyway, so this idea of equity funds is something that is very compelling to me, and it's something that we've been seeing more often here as of late, in particular the fund of funds. And so I was kind of hoping we can kind of break take the kind of basics of, hey, what is a fund? How do we structure it? How do we leverage it? And just kind of keep going from there. So take us from the beginning. What exactly is a fund?
So that's really just a general partnership on one side and a limited partnership on the other. Typically, they consolidate that into just calling it a limited partnership. Now, it can be in the form of an LLC. It can be in the form of a limited partnership. Then you have your limited liability limited partnership. You can create classes of shares. You can restrict voting rights. So typically what happens is you have a couple of folks, let's say Cody and Brian, who are sophisticated in managing the asset, right? In the context of multifamily, most people see that as the operator of the asset, but it doesn't have to be, okay? So let's talk fund of a fund. When you talk just the fund singularly, you're typically just talking the fund that's gonna acquire the asset, right? Brian and Cody are gonna go acquire, the villas down the street for $3 million. They're going to go get a loan for 2.5. They're going to syndicate $500,000 and then bifurcate the ownership of that with their limited partners who don't have any voting rights, give them 70%. They're going to keep back 30%, operate that asset. Well, The fund of the fund is going to go to that LP side on the 70% ownership side. So let's say we have $500,000 on, and this is just a small example. Of course, we could go, I mean, I could give you a $100 million example, but let's keep the numbers small this morning. So let's say you're going to go raise that $500,000. You can find people who create funds that just make placements in other funds. Okay. So the $500,000 that Brian and Cody are seeking for their acquisition would actually be obtained by a single entity. Okay. And that single entity is going to be this fund of a fund. Okay. So then they're going to take $250,000, let's say, and they're going to put that in as an LP. It'll be held in the name of the LLC that's going to own that piece of stake. So it looks like this. So let's say we have fund of a fund LLC. Okay. They're going to create their own LLC that they'll fund, and then that's going to make the placement to the asset. Okay. To the single purpose entity that you create to take that asset down. So it's been a unique concept. And we're working through the value on the GP side of the remuneration that can flow to that GP, where unless you're registered, you're really not supposed to accept commissions and fees. Now, when you're on the LP side and you've made an investment, it's kind of a little bit more up in the air as to whether that was a broker fee or not. And these fund of a fund can be an opportunity to kind of get around that. In a sense that you can go raise these capitals for your own fund, and then you go place into these other fund, and then that income would then flow back to you in effect. So it's really not any different than the singular fund itself. And again, a lot of times what happens is you'll create an LLC, you'll create two classes of shares, just depending, again, to keep it simple. Your Class B shares is going to be your common, and that's typically what's reserved for your general partners or GPs. Then you're going to have your Class A shares, which will be your limited partners. So what you'll see a lot of people do is they'll actually go raise capital, and they can show the same cash flow metrics to their investors and get all of them to group together and then go in and make these placements in these other deals that are high performing. So where the GPs in the fund of a fund are direct with very good operators in the in the actual target fund, you can see the same returns. Obviously, they're going to flow back, and then they can deliver those. They can have the same success fees, GP fees. You can go more of a traditional private equity model, even in that case, where they do 20% carried interest, which is basically the net profit, and then 2% assets under management, 20 and 2, and just kind of build it out that way. And then, of course, you'll still need a PPM and all of that documentation for your LPs that are going to join that fund of a fund. And then that fund then contributes on. And then you just say, hey, instead of our placement going for the, for actually acquiring real estate, we're actually going to make placements into income producing assets where we're not the operator. So the risk factors will be a little bit different. But the general concept of the investment is very, very much the same. And in terms of securities laws and compliance, it's pretty much identical.
I got you. Can you elaborate a little bit more on what are some of or what is the capacity of these funds? Because I know you mentioned, okay, for just, let's say we're creating a single fund and we're going to go out and do acquisitions. Am I limited just to one particular asset in one particular time frame, or is there a window there? Talk to us a little bit about the capacities of these funds.
Yeah. So, yeah, good question. If I understand it correctly, typically you've got, well, it depends. So typically you don't hold your offering open for more than a year. There's some compliance issues that go along with that, and the Reg D notice that asks whether you are keeping it open for a year, and you check no. So then you put in the company operating agreement and in the PPM that the offering will be held open for 365 days, or by automatic operation will terminate at 365 days. So even if you as the manager don't close it and there's still some residual units, it'll close by itself. Okay, you just want that mechanism in there to close it out. Now it depends. So there's a couple of different ways to structure this, all right? And I don't know if 45 minutes will be able to cover it all this morning. But if you do the traditional private equity model, that's more of a capital call where you have these commitments and then you go in, you do the capital call, people put in the capital contribution, then you deploy it on the assets that you've targeted. Okay. The other is to do just a normal syndication, but you're taking down multiple assets. You'll see this a lot in more in self-storage. More in self-storage and mobile home parks. Okay, where they'll open a fund for $10 million and then they'll go make multiple acquisitions. So typically, the success in those really lies in your ability to raise the capital. If you raise the capital quickly, then obviously you have that to go deploy, and then you can take down any number of assets. But what happens is the fund itself will be a holding company, right? Just like a single target LLC kind of acquisition. But then what you're going to do is each individual asset that you take down is going to be in its own compartmentalized and individual LLC. Okay, so you're just going to have the fund holding company that has the 10 million, and they're going to deploy to each subsidiary assets that they acquire. And then of course, all of the revenues of those P&Ls will flow up, and then the cash available for distribution will come from the holding company and then go to those LPs. Once the capital's raised, the fund closes, there's really nothing further to do. And then, from there, you just have all the rights that are expressed in the operating agreement. Does that answer your question?
Yes, it did. Yeah, very, very, very great answer as well. I appreciate that. Very eloquently stated. So, so it kind of gives us a little bit more flexibility, I guess, if you will, in terms of being able to raise that equity. I'm trying to gather my thoughts here to see.
Well, no, you're right, Cody. It does. And the last thing that you can do, actually, which is very novel, is a lot of people, family offices are now more and more getting into these investments. And a lot of times they'll have a portfolio that's large enough, or at least enough liquidity to make acquisitions create their own fund, or to take down their own asset. And in which case, it may not be that you join a GP. You may have the family office itself be the single member of the asset, but you manage it, okay? And that would give you, typically what you'll see there is the 20 to 30% that you would other hold in a GP percentage, you can take in just a management fee. So the way you'd organize that is you have a manager managed LLC, okay? You as the asset manager, the sophisticated operator, okay, would form your own management company, and then that would be entitled to the management fee in the operating agreement. Then you tie up yourself in there in terms of the termination of that manager by an adjudication or some kind of, draconian for cause, so that you can't just be, whimsically removed in your capacity. But the good news is that family office will be able to hold that property in its name. You don't have any GP percentage. You don't have to worry about that necessarily. And then you could get your own property management company to take that. And then you have all the benefits of having a property management company receiving that revenue. You don't get the benefit of cost seg and some of those other tax benefits, which may be beneficial. But from a management perspective, where family offices, can or have less desire to have you as a partner, then going in that management route is a way to get around that as well.
Interesting. Okay. Awesome. And, we kind of alluded to this a minute ago, but why do you feel like we're seeing more of these funds, in particular funds of funds, being created now? And I don't know if it's just coincidence or if it's related to what we've been experiencing through the COVID pandemic, but I feel like we're seeing the creation of these funds and funds of funds more so now. Is there a direct correlation with what we've been seeing in the marketplace, or any insight to that?
Well, yeah, and I've seen the conversation crop up more prevalently. Okay, so there's obviously people in the space. I mean, it's no secret that there are people that have access to capital. Okay, and by virtue of doing so, they have utility to these GPs, right? So whereas you may be a great operator, you may have a great financial mind, You may be a great contractor, and you have these other sort of intangibles that provide value for these deals. You may not have access to capital, so you need to partner with somebody. You can either bring them in on the GP side and bring them in a substantial enough capacity that they're involved to the extent that they're not just a paid for linked capital. And I'm seeing a lot of people go the fund of a fund where these capital raisers will have their own fund, bring that in. And again, their compensation is going to be on that next level versus being on the actual asset level. So they can go in, create their own fees and their own fee structure in their fund, make that placement into the new fund, and know that they're getting their compensation as being that fund manager, right? Where they don't have to be concerned about, whether they have enough participation on the GP side or whether they're a registered representative to the extent that they can accept, compensation for bringing that capital. So that's really where you're seeing the fund of a fund in that regard. You're seeing more of these people who have access to capital creating those fund of funds. The GPs, they don't care either way, right? Wherever the capital is coming from, to the extent that it's legitimate and comports with all their requirements and their operating agreements and other things and securities laws and such, they don't really care. It's the people who are bringing the money who understand their value in bringing that money, who don't want to be scrutinized by the SEC, because typically what you'll do is you'll see a clawback. All right. There may be some penalties and fines on top of that, but they'll also restrict the GPs who brought them in for at least a year. Typically it's a year, and then you can't raise for a year. You can't operate. You can't do any security. You can't file Reg D. You can't be anywhere on those documents. Otherwise you're not in compliance. I have some background in FINRA. I've litigated things in front of the SEC. It's a guilty until proven innocent over there. All right. I mean, and I know that we talk about that even in the criminal justice system here in America. And there's definitely arguments, there. But I can tell you with the SEC, you're guilty until proven innocent. And particularly because they publish these documents, I've seen people be destroyed by mere allegations that have been published by the SEC, and there's no recourse to them. Even if they're completely wrong, that information's out there. They're not going to apologize. They're not going to send out a press statement saying, hey, sorry about that last one. He's actually a really good guy and did everything he's supposed to do. That's never happened. It's never happened. Never will. Right. So just know that, right? If you're a capital raiser, the fund of a fund is a great opportunity to create a fund, lead it. Okay. Comport with your 506Bs, your 506Cs, and obtaining that capital that you have a connection to. Legitimize that. Then make your placements in LP. Cash flows are going to come in, and you'll be able to enjoy those just the same as you would have otherwise. The only real thing that you're missing out on are these success fees on the front end as part of the GP. So if I brought in capital at 20%, you're going to get a $50,000 success fee. You're not really entitled to 20% of that success fee because you're not on that GP side. But at the same time, you're actually following the law. Okay. So taking those fees on GP side when you're just doing some administrative acts and you don't have substantial participation, that the fund of the fund is way to go. People will put investor relations on there. That's cool. Whatever you want to, however you want to dress it up. I'll be honest with you. If the SEC knocks on your door, they know what you're doing. They all know what you're doing. Okay. The thing is that I'm not going to tell you which one I talked to, but I talked to a regional enforcement guy, the SEC, maybe a couple of weeks ago, and they were wrapping up some litigation on a big syndicator. Okay. Well, we have this new rule that's coming out. I don't have the number, and for, in the interest of time, won't search it while we're here, but there's a rule where you can have knowledgeable employees become accredited investors. You can have, there's a new caveat to being able to raise capital as a finder. Okay. And there's two different provisions. Right now it's out for comment. I don't think it'll be promulgated meaning established and brought to the public, until next year. But because this is coming down the line, because it's out for comment, they've actually stopped enforcing. He said, for now, have had some direction. I'm going to just paraphrase all of this, that there hasn't been a ton of enforcement on that side. So I got involved because one of my clients was looked into because of this other larger this larger syndicator. So there are some good things that are coming down the line, but the fund of the fund is just a super clean way. And again, you're still going to get the benefit of your own fund. You can have your own success fees built in there. How you work that out is entirely up to you. Super clean way to get yourself involved in some really good commercial real estate deals.
Hey, Nick, man, you got a lot of information to unpack there. Sounds like to me that the best thing to do is just call you. I think Cody would agree with that. There's a lot of legal terminology and things in there that I think people need to make sure they're being careful of, because I know, sometimes when you're getting started in this space, it's really attractive just to think, I'm just going to go raise money. And I know we hear that very often, and we often get reached out to by a lot of, capital raisers. But the big question I know Cody and I always have is, are they doing this legally? Is this structured the right way? Have they talked to an attorney, or did they just wake up and decide they're going to raise capital? Because I think the hardest part, or one of the hardest parts in the commercial real estate space, is finding the deal, right? So it's much easier to hop on LinkedIn or start networking and start raising capital than it is to go out there and start pounding down brokers or knocking on doors to try to find good deals. But I think the message here is to make sure that they're talking to people like you and setting things up properly so that they don't get any trouble with the SEC, which takes us down to your last point there that I'd love to have the listeners hear more about. I hear you've got some great stories with some litigation and some different instances that I think our viewers would love to hear about. So is there anything you can share with us?
Yeah, I mean, again, that's kind of in the intro this morning. I was like totally scatterbrained, because when you can go in 100,000 directions, it's tough to pick just one. So I apologize for the slow start this morning. But yeah, I mean, look, how about one from yesterday? All right, here's a better one. Yeah. So yeah, I like stuff that's fresh in my mind that I still haven't gotten over. Those are the best ones. So we've been working on this multifamily deal in the Midwest since August. I think we went under contract late August, and $3-something million deal. Good asset. We've got a good team put together. The seller was a typical seller. They were pretty reasonable, but had their opinions about certain things, and really wanted to stick to the terms of the contract and not amend those when their economic occupancy dropped during the period under which we were in contract. So that looked like a 65% economic occupancy. So economic occupancy, of course, is you have your occupancy. Let's just say it's at 100%. All right, just to, again, keep math simple. But you're only collecting 80% of that 100%. Your economic occupancy is 80%. And there may be some other factors that weigh into that. Sometimes people take into expenses and things, but let's, again, keep it simple. So typically your expenses are the same no matter how much you collect. So then your expense ratio will fluctuate with how well you collect your rent. Well, as you can imagine, Freddie Mac funds most of the loans in the small balance loan, okay, the SBL. It's like $5 million and under, all right? And those are just great tools. You get low interest rates. You can get some interest only, for 3 years, 25, 30-year AMs, 10-year notes, just good stuff, okay? But Freddie Mac has very stringent requirements, of course, because we're talking, kind of government stuff here, okay? So to that extent, we obviously get through September as the first part of October. Now, bear in mind, the original close date was supposed to be mid to late October. Well, when the numbers come back for September, the economic occupancy was at 65%. Freddie requires 90, okay? 90%. Otherwise, you have to get a waiver that was like, hey, that was an aberration. Sorry about that. Please don't take that into account. That's not who we are. Just wait, okay? So then we're kind of working with the seller. We're like, hey, seller, that's on you. Your collections were poor. They're like, hey, that's on you. That's the risk you take in the transaction. It was COVID, yada, yada. Well, I've got some COVID language that I now use in my contracts that really provide for 30 to 45 or 60 days that require nominal consideration. So $10 or something like that of the earnest money, whatever, as consideration for basically a free extension if there are delays due to COVID. That provision was not in this contract. So we had to be reasonable with the seller. We're like, hey, we're still trying to buy it. We have all the money raised. We have the funding is pretty much lined up, but they're not going to close until we either get a waiver or so we get a waiver. Well, fast forward a few weeks, we get the waiver. So we're like, all right, we got this waiver. We need to, we'll be good. They're like, but we need to make sure that October is good. And then we need to make sure that November is good. So what they do typically is when they determine the loan to value, they you kind of start at the 75% and then they knock you down depending on your T3. So what are your trailing three months expenses in light of your economic occupancy and your collections and all of that to determine what their risk tolerance is for you, and which then determines the loan to value. So yesterday, I'm driving back from a small kind of impromptu family vacation, feeling good, had a great time. All of a sudden, my client and partner text me fuming, okay? Well, because September is included in the T3, because now we're looking at November, October, and September as the T3, okay? Then they're taking that bad month of September and factoring it in. We were preliminarily approved for 75% LTV. They dropped it down to 71%. So guess what? 4% of the purchase price now has to be provided in liquidity as the down payment on this deal. So imagine having the whole thing raised for 30 to 45 days, telling all of your investors that the deal hasn't closed yet because of all these crazy timelines. Then at the 11th hour, you find out from your lender that, oh, hey, by the way, the loan to value dropped from 75 to 71, and we need $130,000 more to make your deal happen. Now, a couple things can happen. I'll tell you, the story ends well. Let me just tell you that, okay? The story ends well, but here's why. The planning that happened on the front end made all the difference on the back end, okay? We keep enough reserves, okay, for any contingency, whether that be HVAC considerations, roof, parking lot, reno budget with, contingencies built in. We were actually able to absorb that $130,000 because we had so much in reserves. Our rainy day fund was able to support that. Okay, not everybody's going to have that, but that's why you have to underwrite these things and do your capital raising strategically and conservatively. And by conservatively means sometimes you need to raise more money than it takes, of course, to close the deal and of course to cover your reno, but you have to work in enough proportion of these expenses to be able to absorb these contingencies that may crop up. This was sort of the biggest last minute thing that I've seen. We didn't suspect this. Our lender didn't hear about it from Freddie until they heard about it from Freddie. And so just a caution to the listeners, put more money in reserves. There's a value in that peace of mind that you have, but also things may crop up where you're going to be glad you did. Had we not had that rainy day fund, we would have to go out and raise the additional capital. Well, if you've already made representations on ownership of the company, then typically the GP is going to take the hit, right? So to maintain the same cash flow that you have, you're going to have to increase the ownership on the LP side. The only way to do that is to take those units from the GP side. So where it was a 70-30, now you're looking at 73, 74, 26, 27 split, right? Freddie won't let you borrow it in debt and put it on the balance sheet. Okay, so it really has to be an equity raise. Sometimes the GP has enough money to put that capital in there. Sometimes they don't. But if you raise enough money on the LP side, you'll be able to absorb these contingencies and move to close, which, fingers crossed, prayers up, happens for us. I think we're anticipating the letter to come down today from Freddie, and then we close next week. So that was the fun fire drill that I had going 75 miles an hour down the highway.
Wow.
That's a great story. I mean, I'm sorry, it's a lot of headache, but it's a great representation. We talk about this a lot, and this is really one of the reasons for the show is to help people understand that, not only is this a lot of work that's involved in being in this business, but there is so much that you can come across that you just can't anticipate or expect, right? And you talk to any operator, any syndicator at any level, and they have similar stories in that, man, there's always that one off that they've never seen before that comes up. Every deal is different. Every transaction is different. Look, every market cycle is different. I mean, look where we're at now in COVID. Nobody's dealt with a pandemic like this before. And so, hearing stories like this, related to some way from the COVID impact, you're hearing it more frequently. And so, as Brian, mentioned a few minutes ago, it's great to have people like yourself with your experience, not only as an investor, but as a legal counsel and advisor on your team to kind of help you navigate these very complex circumstances that tend to pop up. So appreciate you sharing that story.
Absolutely. And look, to the extent I can, I'd love to make available to your viewers. If they reach out to me, I'm happy to provide even that COVID language, that blurb to put in the contract to help with that. I'd love to be on the show again and maybe talk about some timeline specific things. Hopefully you guys found some value in the talk of the fund, and that hopefully this will educate some of our capital raisers who can do member loans to the company to finance these PPMs to create their own funds. But there's just so many ways correctly to do this and properly to do this. And to underscore what you said, and I appreciate it so much, the relationship that you have with your counsel is perhaps the most integral, and to reach out on the front end to get these funds of funds going, to raise capital, to Brian's point a moment ago, because then when you do reach out to the brokers and you do start going for assets and you've got soft commitments, it gives you a lot more bargaining power. It gives you a lot more credibility. So being able to arrange those things on the front end and then going out, look, there's going to be sellers, there's going to be properties, but take advantage of the people who are trusting in you to make these placements for them, and use that sophistication, but do it correctly.
Yeah. That's a great point. I'm so glad that you mentioned that. Thank you so much for that. And I agree. I definitely would love for you to come back on the show and kind of continue the conversation, because I think we just barely skimmed the surface of capital raising, fund to fund. I've got so many more questions that we'd love to go through, but we'll definitely have to have you back sooner than later. But listen, as we're getting near the end of our time here, I would like to wrap up with a few more questions for you, and then we'll call it a day. So, one thing that we love for every guest is to figure out or learn about what you're doing for your continued education to further your investing.
Yeah, great question. So obviously in the legal profession, you have CLE. So that's the continuing legal education here. I try to find things that are important. I don't just go, which I did a couple of years ago. I did a trip down to St. Simon's, did some trust institute that had nothing to do with my practice, just to get an expensible trip. But now there's so much value in these CLEs where the practitioners who are putting them on have great advice and great experience. So you can pick up a lot of practice pointers there. So just a small point on my CLEs, which are again required, I try to go things that actually help enhance my practice. I get the books and things, I keep those, I read them, and they increase. Okay. Now, in terms of privately, the beautiful thing is that while I do these deals for my clients, whether as partner or as just as transacted counsel, I get my hands on these deals. I get to look at their pro formas. I'm in perhaps the most unique situation of anybody, because I see such a different variety of deals organized so many different ways. I also represent a number of LPs, okay? So if you're a limited partner out there, you need an opinion on, a PPM or an operating agreement. You don't understand kind of exactly what's going on. I charge just a flat fee to review, talk it through with you. I've had GPs change terms, clarify terms, and do all of that based on my review. So that helps keep me sharp. So as I continue to go through your documents with a fine-tooth comb, I'm synthesizing these things for my own benefit. So when I go to place in a deal, or I go to be a GP in a deal, I get the benefit of all these valuable things that have come across my desk and put them in one central location. And that's why I'm very excited to kind of start my own property group and deploy what I think is an optimized offering from which I've been able to benefit, through experience with, dozens and I can't say hundreds of deals, but dozens and dozens of deals, to the extent that the only thing that is surprising is the different classes of shares that people come up with. Those are interesting, and I learn a lot. And here's class A's, B's, C's, D's, A1s, twos, and I'm like, all right, some of that gets crazy, but you can look and see if the numbers check out and the allocations are correct, and these pro forma financials are on point. Every single one that you look at makes you better.
Yeah, yeah. It's learning firsthand versus just reading in a book. It makes a big difference. So I
And
appreciate
that conversation and the way to get that, because there's a lot of viewers and listeners out there who are not going to have access to the deals like I would necessarily. But that's also why contracting an attorney that can have this conversation with you and explain these things to you. I don't hold anything back with my clients. I hope you can tell I haven't held anything back today in this interview. I want you to know what's in here. I want you to be great, and because I want you to come back, and I want to partner with you.
Awesome, man. Excellent. So Nick, what have been some of the lasting lessons that you've learned along your journey, whether it be from the legal counsel or as an investor?
Man, I mean, they're just innumerable, really. Just having the best advice that I can give an operator, if you're not the finance guy, go get one. If you don't have a finance guy on your team who's running these numbers and can run them confidently, explain them, and argue you down because they're right, you need a new finance guy. Okay, you can't. Otherwise you're blindfolded. Did you see my LinkedIn post the other day where it was like the live look of a buyer seller going into a transaction without counsel, and it was the Bird Box Sandra Bullock thing? Yes. Same thing with finance. I love my CPAs, best friends. Okay, they make the financial stuff work. I've seen too many people try and jump into a deal, and they did 5th grade math, to try and justify their deal. They get in, and then personal guarantees are being enforced because, they're not making the progress that they anticipated because their numbers weren't done correctly to deter them from the asset. So get a finance guy, get these professionals like Brian alluded to, forge these relationships with brokers who are going to help you find the deal. That's about it. Love my brokers, but at the end of the day, the people who are really and truly on your team are going to be your finance, your relationships with capital, whether those people have a sophistication or it's the relationships with the fund of funds, as we talked about. And then, of course, legal counsel. But don't shortchange yourself. Don't shortchange your investors and exchange or substitute their advice for yours. Okay. Then I'll have to litigate it, and that gets expensive.
Well, great advice, Nick, man. Really, really appreciate you sharing that. Tell the listeners how they can learn more about you and your legal practice and how they can get connected with you.
Well, I appreciate it. So I am on LinkedIn. It's under Nicholas G. Moore. It'll be Nick after we first talk. So look for me there. Yellow necktie, blue suit, Capital Law Group of Georgia. Licensed in Georgia, but have all of the experience federally to be able to do the securities laws nationally. To the extent the asset is located in a different state, we just contract an escrow agent locally to make sure that the responsibility to record things correctly, handle funds, and do all the disbursements are done on the local level. And that's been able to get me into a number of states. You can reach me by email at any time. That's N Moore, first initial last name, at capitallawgroup.co, not .com. I've probably lost 100 deals because people email me with the M on the end of it, but it's .co. Email me anytime. Self-proclaimed workaholic, but a family man to boot. Great work-life balance. I love life. I love my profession, love my faith, my friends, and I love this industry. And lastly, I'd love to talk to you and share even more wisdom with particular things that may need to be addressed.
Well, Nick, man, really, really appreciate your time this morning. Great conversation. Look forward to having you back on the show, and want to thank you again so much for joining us today.
Absolutely. Sorry for the slow start, man. We had to reel it in this morning after my vacation, man. I'm like, where am I? But you guys did terrific, gracious, wonderful hosts. Great podcast. Cody, I've always enjoyed our conversations and emails. Love your spirit, man. Brian, awesome to meet you, and look forward to mixing it up with you guys here, hopefully in the near future. If we don't speak, have a blessed holiday season, a happy new year, and just reach out if y'all need anything.
Thanks, Nick.
Awesome. Thanks, Nick.